Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here. Today will be the Friday, the 3rd of October 2025. So before we kickstart today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, let's have a quick recap what has taken shape yesterday. So bear in mind, today will be the full suit of the daily dose, where I will cover all the intraday technical outlook for those 12 instruments that we spread across the global asset classes, ranging from the FX market, the major stock indices, and as well as the commodities markets, which is Gold XAU/USD and West Texas crude oil. So let's have a quick recap what has taken shape yesterday in terms of economic data, news flow, and as well as in today's Asia session, the relevant data as well that has a impact on the respective intraday movement of all those broad-based cross asset classes that we cover on a frequent basis over here. So yesterday is the second day of the US government shutdown over here. So the impact of the US government shutdown in terms of key economic data release will be those data that's been compiled by US government agency, like for example, the Labor Bureau, will be delayed. All right. So yesterday, we do not have the release of the what I call it, the weekly jobless claim data over here. So let me share with you what we So on Thursday, the weekly jobless claim data and as well as a report on factory orders were delayed, and very likely today's non-farm payroll data will likely to be pushed back and delayed as well. So the reason over here is that because of the government shutdown, and it was publicly broadcast on the website as well over here. Let me show you where is the website. 1 second. Yeah, this is the one. Okay, let me bring this website out. Right, so over here, this is the US Bureau of Labor Statistics, which is in charge of the release of the government compiled non-farm payroll data and the unemployment rate that is due today. Given this, we call it government shutdown, they will suspend the update of this data. So very clearly that this website is currently not being updated due to the suspension of federal government services. The last update was on the Wednesday, 1st of October. So very likely today there will be no release of the non-farm payroll data, but market participants will focus on another privately compiled key US economic data. So later I'll share with you guys what is this data to look out for in today's trading session when I come to the third segment of today's daily dose over here. And what's interesting yesterday is that as we are in this midst of this US government shutdown, very likely will be the brinkmanship play between the Republicans and the Senate as they jostle for vote buying in the next midterm election, which is in 2026 over here. So both parties is trying to blame each other for the current situation, which led to this government shutdown. And Trump upped the ante by threatening to fire thousands of federal workers. So we know that in previous US government shutdown, workers were told to leave their posts, but that's only temporary. That's once the government reopen, these government agency workers will be back into their jobs position again. But Trump this time around, he wants to make this we call it permanent. That means, i.e., these workers will be permanently fired from their government position. Then from there, he will push the blame on the Democrats, stating that they are the guys who caused this in light of this brinkmanship play, hoping for the Republicans to gain more votes in the Senate in the next upcoming midterm election. So the key thing over here is that the US stock market tends to be forward-looking. Despite this bad news that where Trump threatened to fire thousands of federal workers, that means, i.e., going down the road in the next few months, the non-farm payroll data will see a very lackluster job data print for the month of October, and also the unemployment rate may spike up from 4.3% to 4.6 or 4.7% as being we call it projected by other privately so-called economists in the private sector over here. But that actually is a trigger for a positive feedback loop into the US stock market. Why? Because with more firings coming into play, it led to the US Federal Reserve to turn their focus more on cutting rates to support a rather weak job market rather than holding rates for this stubborn inflation that is still sticky above their long-term desired 2% caused by the current White House administration global trade tariffs policy, and that has been reflected in the Fed funds futures market as being compiled by the CME Fed Watch 2. So let me share with you the current pricing behavior taken into the trading activities of the traders in the Fed funds futures market compiled by the CME Fed Watch 2. So right now, based on the CME Fed Watch 2, Fed funds futures trader has pricing almost 100% pricing, that 100% chance, almost 97.3, that the US Federal Reserve will ignite. Give me a minute. 97.8 right now. 97.8. Okay, is it the correct one? Wait 1 second. Let me do a check again. Yeah, it should be 29th of October. Yeah, so right now on the next upcoming meeting, which is towards the end of this month, on the 29th of October 2025, Fed funds futures traders has priced in almost 100% chance, to be precise, 98% chance that the Fed will do another 25 basis point cut to bring the Fed funds rate to 3.75% to 4%. And what's interesting over here is that the last meeting of the year, which is on December, on the 10th of December 2025, the odds has increased significantly. So yesterday I shared with you guys it's hovering around 70% to 70% plus. Now it has almost jumped up to 90%. So now almost the Fed funds futures trader has priced in a high certainty that the Fed will be forced to actually cut rates for the third time this year to enact the third cut on the 10th of December 2025 meeting. All right, to bring it down to 3.5% to 3.75%. That is much lower over here. And interestingly, for the next year at 2026 over here. So in 2026, if you still recall that in the last dot plot that was released on the 17th of September FOMC meeting, the US Federal Reserve official median projection, they only projected one interest rate cut for 2026. But this time around, the Fed funds futures trader has now started to turn more dovish, penciling 3 cuts over here. So the first cut to come in the 2026, that means i.e. overall it will be an interest rate cut cycle. So that will be a fourth interest rate cut. So the fourth cut will come in on the March meeting of next year, 18th of March 2026. High chance of an 87% probability. Then thereafter they pause, and the fifth cut for this ongoing interest rate cut cycle that has kickstarted in last month, 17th of September, after the 17th of September FOMC meeting. It will be on the either on the June, July, September meeting, because all of them represent a more than 50% chance over here for the so-called the fifth cut to come in either in this June meeting next year, July meeting, or September meeting. But what's interesting over here is that the so-called sixth cut for this ongoing interest rate cut cycle, more than 50% chance right now, at 59% chance to be precise, 59.2% chance to be precise, for the sixth cut to come in on the 9th of December 2026. So now Fed funds futures traders now has increased the odds for the 9th of December 2026 FOMC meeting, therefore increasing the odds for looking out for a 3 interest rate cut in 2026. At the end of the 2026, it will potentially brings the Fed funds rate lower to the 2.75% to 3% mark. So that create a increase of dovish expectation into the US Federal Reserve, they being skewed towards reducing the potential, we call it lack of demand coming out from a softening and deteriorating US labor market. But that is potentially good for the stock market, at least in the short to medium term. And the stock market reacted positively to that. And that also came in line with our short-term intraday technical outlook, which I've been sharing with you guys that right now we are still seeing low probability of a medium-term bearish top in the major US stock indices, as this ongoing bullish acceleration phase still remains intact so far. So what we could see is that the S&P 500, the Nasdaq 100 all rallied to fresh all-time high yesterday. So the S&P 500 added 0.06%, the Nasdaq added 0.37%, the Dow Jones 0.2%, and the top performer is the Russell 2000 that tends to benefit from a lower interest rate environment due to a weaker balance sheet that is being supported by higher gearing ratio relatively compared to the other three major US stock indices. So the Russell 2000 outperformed with 0.7% gain over here. All right, so that's for the US stock market. Then going forward to the FX market over here. So the FX market, yesterday we see a bit of dollar strength rebound over here. So this is the 5-day rolling performance of the US dollar against other major currency as of 2nd of October or 3rd of October we are speaking right now. All right, let me change this. Okay, to 3rd of October. All right, so yesterday we see a bit of a bounce in the US dollar over here after 4 days of consecutive decline. So what do I mean by that? So if you to look at the US dollar index over here, yesterday they managed to do a bounce, all right, a bounce after 1, 2, 3, 4 days of decline. Yeah? And the bounce, they managed to survive exactly at the 20-day moving average. So yesterday it added a gain of 0.2%. But however, this gain was short-lived. If you look at the long tail of this candle, where it got rejected at the 50-day moving average over here, acting as a intermediate resistance. Okay, which is around 98.05 over here. So very likely today's scenario will be sandwich. It will be more like a sandwich range for the US dollar index over here. And also bear in mind that one of the reasons is caused from the yen side of the story. So if you look at the 5-day rolling performance of the major of the dollar against a major currency, if I were to reduce down to a 1-day rolling performance, taking into account the last 24 hours, we see the dollar yen now trying to spike up on the intraday basis, up by 0.3% so far as we are speaking. So one of the reasons why dollar yen actually bounced, this minor bounce, which is more or less being expected, because yesterday the dollar yen retested a medium-term range support at the 147.30 level, or very close to it, and before shaping today's Asia session bounce. All right, so later I'll share you the technical chart of the dollar yen so that you guys get a very clear picture of what I'm talking about. So the reason why for the dollar yen intraday to bounce today, that causes the dollar strength to come back as well. In fact, it started to bounce yesterday, not even today. Even yesterday, it started to bounce already. All right, over here. All right, yes. Okay, so the reason why it bounces because there's two events that actually created this dollar yen bounce. One is today there's a public speech by BOJ Governor Uda. So Governor Uda keep a very kind of a data dependent approach in his speech over here, avoiding any clear hints on rates over here. So he mentioned that he still keep his policy option open by reiterating the bank's long-held stance on interest rate, avoiding sending any clear signal about the prospect of a rate hike when the board meets later this month. So far for Q4, the market in the short-term swap market in Japan still pricing in a possibility, I would say a high also possibility of a 25 basis point hike, not cut by BOJ before 2025 ends over here. So he mentioned that the baseline scenario for economic activity and prices outlined so far is realized. The bank, in accordance with improvement in economic activity and prices, will continue to raise the policy interest rates over here. So he mentioned over here, yes, the banks will continue to maintain its monetary policy normalization stance. So this normalization stance is a gradual increase of short-term interest rate, provided, because the measurable if the baseline scenario for economic activity and prices outlined so far is realized. So he always, this meaning that he's still in a data dependent mode over here. So that actually causes the dollar yen to rise after the dollar yen yesterday tumbled and hit a medium term range support level at the around the 147.30 mark. And also there's this key risk event that's going to take shape over the weekend, which is this coming Saturday. So this coming Saturday, there will be this LDP. LDP is the current governing political party in Japan, where the prime minister resigned over here, and that left a leadership vacuum. Okay, over a leadership vacuum. And tomorrow, within the LDP ranks, they will start to vote for the next Japanese prime minister. So far, there is these two names that are jostling for leadership over here, which is Shinjiro Koizumi. So those we call that Koizumi. This is the son of the previous former prime minister in Japan during the late 1990s over here. And we have the far right leaning Sane Takachi over here. So these two names, Shinjiro and Koizumi, and this Sane Takachi will be the jostling for leadership. And based on private polls over here, both of them are leading neck to neck. So there is no clear cut who is the winner. It's either one of them over here. So given this situation, potentially there could be some positioning adjustment on the dollar yen ahead of this vote that is taking shape. And given the fact that the dollar yen yesterday came close to a key medium term ascending range support level, that also preventing the bearish, we call it traders, to take aggressive bearish bets on the dollar yen ahead of this key risk event. All right, over here. So let me share with you basically what are the hedge funds are doing over here. So hedge funds are chasing profits from 9th Edge Japan LDP leadership election that to determine who is the next PM of Japan over here. So basically, let me share with you guys over here. So some of them are positioning for a stronger yen, while others are waiting for opportunity to boost holding of certain assets. All right. So let me share with you guys what do I mean by this. Okay. So let's look at the positioning of the futures market. All right. So this is based on the futures market over here, means yen futures contract, not the spot FX market. So based on this yen, we call it futures contract, the latest net positioning as compiled by the CFTC. So CFTC is the what I call it, the centralized kind of exchange in the US. The futures, is part of this centralized futures exchange in the US, where every week they will release the net positioning as per reported from the various stakeholders in the futures market. So we have small speculators, large speculators, and asset managers. So asset managers tends to be hedgers over here. So basically, this is what being compiled by Bloomberg and taken from the data from CFTC. So based on the latest data, what we could see is that asset managers, so these tend to be hedgers, net long yen position. This is the futures market, remember, it's not the spot market. All right. So the net long yen futures position, net long, all right, by asset manager. Then this is where the leverage funds. So leverage funds are large speculator that use margin to actually more margin to trade. All right. So these leverage funds over here, in fact, they are not net long. They are more net short as a whole. Right, as a whole, that means they are more short than long, but that's why you see the net long yen position has declined over the months. So net leverage traders, that means those large speculators, that means i.e. should be hedge funds, they are not so optimistic on yen strength revival. So that explaining their net positioning in the futures market. So what it means over here is that given the fact that these are leverage traders, more leverage trading, that means they use margin to trade, that means i.e. there will be stop loss deployed in their strategy. So if the yen after the election, the LDP election over the weekend on Monday starts to shoot up, that means yen strength coming back, these guys here will be forced to close out more of their net short position to reverse to a net long position. So that could create a positive feedback loop into the yen because of positioning unwinding. All right, so bear in mind that over here this could happen based on this rather lackluster net long yen positioning by large speculators, leverage funds, which is hedge funds, that deploy more leverage on their strategy, where they may be forced to readjust their position if the yen spike up. That means dollar yen plunges, yen spike up on Monday due to either stop loss or a position got to close or readjustment of their less optimistic yen strength positioning, given that they are highly leveraged in their position. All right, and also another data I'll share you guys is based on this is Citibank being compiled over here. So what I mean by this is a yen positioning alert indicator as compiled by Citibank. So meanwhile, a Citigroup indicator for the currency funds positioning sank this week to a lowest level since June, pointing to a possible increase in bearish bets. That means indicating that fund positioning on the yen bearish side bets increase. That means more positioning on yen to actually plunge against the dollar. That means yen bearishness. So like I mentioned over here is that if this is so bearish right now in the positioning, what if the yen starts to reverse upwards on Monday after the LDP election? That could actually force a lot of prior players who are positioning on a further yen weakness to reverse their bets, because either stop loss position are being closed out, and that could force a yen strength tremendous reversal to the upside. That means dollar yen plunging down further. That means yen strength coming in, dollar yen plunging down further because of this rather extreme pessimism about the yen that would be weakening further by positioning that show an increased amount of bearish yen bets over here, and that also has been seen on the dollar yen 1 week risk reversal in the option market as well. So option players also expect the yen to weaken further ahead of the LDP election. But so then bear in mind, we've got to be very mindful from a risk management perspective. What if suddenly the dollar yen didn't move as expected by these players over here in the option market and as well as the futures market I shared you guys earlier, and also based on this yen positioning alert indicator as being compiled by Citigroup, as being we call it published by Bloomberg over here. So that will cause what I call a drastic unwinding of earlier yen bearish bets to flip it to a bullish positioning due to stop loss level being triggered and readjustment of these players earlier bearish bet position on the yen. So something to be mindful of over here. All right, so that is the LDP election upcoming on Sunday. So basically then thereafter, let me share you guys what are the so-called pet project by these two potential candidates that would be the future PM of Japan. Okay, let me share you guys over here. Okay, where is it? Yeah, okay. So initially, many Bank of Japan watchers see a slower pace of hike if Takachi is chosen, given that she is an advocate of monetary policy easing. Then Koizumi is being seen as more open to incremental change and keen of boosting wages and productivity. So Koizumi seems to be more better for the stock market, i.e. per se, because he's keen of boosting productivity, which is good for the Japanese stock market, and boosting wages, which will potentially also increase consumer spending and consumer confidence in the Japan economy, in turn also fueling positive feedback loop into the Japanese stock market. But in a recent week, both of them, Takachi and Koizumi, has moved to the center to avoid a repeat of prior leadership contest. So Takachi hasn't repeated her anti-rate hike comments so far in the last 1 week or so, that raw market last time, and Koizumi has also softened his reformist image over here. So both of them try to actually go to the middle ground. all right, rather than taking two extreme end of the spectrum. So based on the Nikkei poll, the Nikkei Asia poll, so far this is the latest one done by them, stating that consuming leads the race for party hit. All right, so apparently, yes, we know that it's a neck-to-neck race, but right now, based on this Nikkei Asia, we call it a poll over here, as reported, it seems to be that this guy is leading the front. All right, so that also explains why Japanese stock market today has rallied, because this guy tends to be favored more on the reformist side, boosting productivity and calling for more increase in wages for Japanese workers. So that overall created a positive, have a positive consumer confidence impact in the Japanese economy, thereby creating a positive feedback loop into the Japanese stock market. So the Japanese stock market is up by 1.44% right now as we are speaking. All right, so that's for the Japanese side of the thing. And now let us move on to the commodities. So commodities, gold yesterday do a profit taking. So gold yesterday was kind of lackluster after a very strong push up at the start of the week. So gold yesterday managed to shed negative 0.23%. And in today's Asia session, there are further profit taking place at negative 0.4%. So later I'll share with you, very interestingly, the plunge in gold yesterday managed to find support level that we highlighted yesterday as well, tighten support level at around the 3,828 levels. Later I'll highlight on the short-term intraday chart of gold. So far, gold right now is doing a bit of profit taking, but based on the short-term chart, it doesn't seem to be showing a deeper minor corrective pullback. So later I'll share with you guys. So big movement in West Texas crude oil yesterday. So West Texas crude oil yesterday plunges further. So those recall who follow my daily dose of market analysis, I've been saying that the West Texas crude oil, whatever rebound that we'll see so far in September, is more corrective in nature because the longer term trend for the West Texas crude oil is down, being supported by stakeholders. Number one, OPEC Plus refusing to actually reduce or take back their production increase or production hikes, and also being pressured by the US, where the US White House administration favored lower oil prices at around the $50 US dollar per barrel. So yesterday, WTI crude oil price continued to plunge negative 1.82%. This is it's so far 1, 2, 3, 4, 5 days of consecutive decline, and right now is testing a key medium-term ascending trend line support at the $60.55, $60 US dollar 0.55 level, which is very key. So this is the turquoise green line over here that I highlighted, ascending trend line from the low of 9th of April, and also the minor swing low of the medium-term swing low of 22nd of May and 2nd of June. And so far right now, if you look at the oil price over here, let me share with you guys, where's the oil price? Yeah, this is the oil price. So oil price is on track for its biggest weekly decline since June this year, ahead of this Sunday OPEC Plus meeting. So the alliance is scheduled to meet online on this Sunday, and this decision right now, it will actually fast track further output hikes for November over here. So because of this, previously in the month of September, they decided to actually raise output further. This was the previous hike for the month when September they meet. So October this month already settled. So for October this month, they are agreed to actually increase 137k barrels per day for October. But this time around, right, they are actually so-called, according to some media reports over here, they expect to increase much further. So previously it was, oops, come on, man. It was 137k barrels per day, and rumored right now for this Sunday meeting, they will increase higher by more than 4.5 times to 500 barrels per day starting in November, almost tripling the increase. Come on, almost tripling the increase for October. So that created a negative feedback loop into the oil price. All right, so indicating that number one, oil market will face an abundance of supply from OPEC Plus, i.e. likely to be political driven. This is being pressured by the US White House administration. And secondly, also due to the upcoming deteriorating lackluster US labor market could further reduce demand for oil prices as well. So it's more like a dummy whammy, slow demand of oil price and increased supply of oil. All right, over here. All right, so that sum up the first segment of the daily dose. All right, over here, more things to say because of these key important events that I'll share with you guys that could shake the market or create a volatile movement in the broad-based cross asset classes, respectively. All right, so now let us start with the intraday technical outlook of the FX market. All right, before that, let me expand my screen so that you guys could have a better view of the charts. All right, so let us start with the FX market first. Okay, give me a couple of seconds. The screen's a bit slow. Okay, good. So let us start with the euro dollar. Okay, so the euro dollar managed to bounce off from our previous short-term pivotal support that I highlighted earlier on, as being the euro dollar being the chart of the day previously at 116.80, managed to bounce off after yesterday's intraday push down. So this 116.80 is indeed a key short-term pivotal support and also confluence with the 50-day moving average, and also the upside trigger level remains the same at 117.60. Which yesterday price action attempt to rally earlier on during the European session, hit a high of 117.58, give or take, very close to 117.60 before that intraday sell-off took shape at the start of the US session. So these are the two key levels to watch. So still maintain that bullish bias of 117.80. This support level hasn't been broken to the downside, but the upside trigger to increase the start of a fresh impulsive minor impulsive bullish up move sequence. The price action of the euro dollar got to clear above this potential upside trigger level at 117.60, where bulls got stubbornly rejected yesterday again as well. So only a breakout above 117.60 will expose the next near-term resistance level at 118.20s, followed by 118.60. But however, if price action can't able to maintain the bullish momentum and break below 116.80, then this bullish bias for today will be invalidated to see another round of choppy minor corrective decline sequence unfolding, exposing the next near-term support level at 116.30, 116.50, which is the minor swing low area of 2nd of September and 4th of September. If this level couldn't hold, then this corrective decline sequence will extend further towards the downside to test this medium-term pivotal support level at 115.70, which confluence with the medium-term ascending trend line drawn from the low of 3rd of February 2025 low. So that's for the euro dollar. Next up will be the sterling dollar. So sterling dollar, very boring. Continue to trade within the range over here. So previously we have a medium term, we have a short term neutrality stance. So the neutrality stance still remains the same. In the last two sessions, it can't break above the 20-day moving average, and it plunges below the 50-day moving average again, but managed to held above the lower limit, the lower limit of our neutrality range that we mentioned previously, which is 133.90. So no change. Maintain my neutrality stance for the sterling dollar for today between 133.90. Upper limit will be 135.10/135.35, which is also confluence with the 20-day moving average, where the bulls got rejected in the past two sessions. So that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar, previously we do have a bullish bias. So the bullish bias hit our first resistance level before trading down and traded sideways over here. So with that, I will use a slightly adjusted upward pivotal support for today at the 0.6575 level over here. Okay, which is also the previous hammer candlestick low on Tuesday, 30th of September at the 3 p.m. mark Singapore time, the long pin bar. So yesterday, it also managed to form this bullish hourly candlestick hammer again, a long tail pin bar, right exactly above 65.75 during the 11 p.m. mark Singapore time yesterday, Thursday, the 2nd of October. So with that, I'll be using 0.6575 as my adjusted pivotal support on this Aussie dollar as it continues to trade in between this expanding wedge configuration that is still intact since 22nd of April low. So since April low level. over here. So with that, first resistance level to watch in this bullish buyer scenario will be 66.20 for sure. Only a bullish breakout above 66.20 will increase the odds of another round of fresh, impulsive, minor bullish outmove sequence to revisit the next resistance level at 66.50, followed by 66.80/67 figure level, which is the bulls got rejected ex-post FOMC during that point in time on 18th of September. Only a bearish breakdown below 65.75 short-term adjusted pivotal support will invalidate today's intraday bullish biasness to see a float down towards the lower limit of this expanding wedge range configuration in first step, coming in at 65.45, which corresponds with the 50-day moving average. A breakdown below 65.45 will expose last Friday minor swing low area, which is the 26th of September swing low area at 65.30/65.20. So that's the Aussie dollar. Next up will be the dollar yen. So dollar yen yesterday plunges down, and it managed to reverse right exactly at this lower limit of this ongoing bearish ascending wedge range configuration in dotted gray line over in this depicted by this gray line. This is the upper boundary, this is the lower boundary. So you realize that it's a ascending wedge. Why? Because why ascending wedge? Because the white spaces is getting lesser and lesser as is. That means, i.e., the movement on the upside is getting lackluster because the gradient of the upper limit, the slope is getting less steep. It's a flat slope. So this representing every bounce it bounces up, the bullishness gets reduced, right? So that's why it's called a bearish ascending wedge range. That's explained to it. So from the low of 22nd of April, it's still evolving in this bearish ascending wedge range configuration. Yesterday, it almost tested the lower limit at 146.30, which is my medium-term range support level that I mentioned earlier at the start of the daily low. So yesterday's intraday low is 147.26 over here. No, sorry, yesterday intraday low was 147.60. Pardon me. Yesterday intraday low was 14. Pardon me. Yesterday intraday low was 146.60. Okay, a bit of tongue twisting. Yesterday intraday low 146.60, slightly above the 146.30, which is the current ascending wedge range support level. All right, so it shaped a bounce yesterday. So let's see what is the intraday outlook, the intraday levels on the hourly chart. So this is the intraday outlook level. So price action bounce over here after the hourly RSI hit the oversold level. So now the hourly RSI is almost coming back to the overbought level. So right now we see it the mean reversion of the bounce has really reached the zone of the 20-day and the 200-day moving average, very close, which is at 14680/14810. Okay, then if you do the Fibo retracement of this sell-off from the top of the expanding range, which is my medium-term pivotal resistance at 149.90, all the way down to yesterday low of 146.60, slightly above the range support of 146.30. Okay, let me do the Fibo retracement. Okay, this is the 38.2%, and the golden ratio of 61.8% is at this zone here, 148.60/90. So what I'll do over here is that, given the fact that the hourly RSI is coming to the overbought level, the daily elements is bearish. Why? How do I know that? The daily, because of the daily MACD. So you look at the daily MACD, right? It has a bearish reaction of this descending trend line that's being formed, and also there's this bearish crossover that's being flashed out over here, indicating that the trend is about to change to the downside. It means sideways to downtrend. So that's for the daily chart. All right, so given that the daily technical elements are bearish, so from a short-term basis, I will use any potential bounce to maintain my bearish bias on the dollar yen instead. All right, so any bounces that will maintain below the golden ratio of 148.60/90, so that will be my pivotal resistance zone for today, slightly higher than the 20-day and the 200-day moving average, which is 147.80/14810, given the key risk event that's going to take shape this weekend, which is the election of the LDP election to select the new Japanese Prime Minister, which I highlighted earlier on at the first session of the daily dose. All right, so any bounces below 148.60 14,890. That will be my short-term pivotal resistance level. Maintain that bearish bias of the dollar yen. Support level to watch for sure will be 14630. A breakdown below this 14630 will trigger off a medium-term bearish breakdown on the dollar yen. In the first step, to test the next intermediate support at 14510, which is the former minor high of 3rd of July. Only a squeeze up above 14890, potentially seek out another challenge on the upper limit of that ascending range top configuration, which is my medium-term pivotal resistance at 14990. So that's for the dollar yen. Very quickly will be the intraday technical outlook on all the major stock indices, starting with the Hong Kong 33. So still remember that Hong Kong 33 yesterday, I shared with you, that's my chart of the day, but bear in mind there will be a pullback taking shape because the Hong Kong 33 is fast approaching a major resistance at 27,500. So let me very quickly share with you all what is this 27,500 again. So 27,500 is a bunch of Fibo extension cluster level hovering there, and graphically is this long-term circular descending trend line that has been in play that kept previous bulls since the current all-time high that was printed in January 2018, way before the COVID period over here. So this is a very important resistance level. So once this level break out, potentially we may start to see a start of a major bullish uptrend phase of the Hong Kong 33, representing the Hang Seng Index, given that the 31st of October 2022 low and the 22nd of January 2024 major swing low. This is the potential double bottom formation over here. All right, so back to the intraday chart of the Hong Kong 33 for today's intraday technical outlook. Minor pullback. So minor pullback now is fast approaching a first support level at the 26,930 level over here. So still no change, right? Still I'll be using the pivotal support to be slightly lower at 26,560 over here. So this 20,560, if you do the Fibo retracement, that also constitute with the golden ratio as well of 61.8%. Right. So if I were to share you guys, I shift it to the, this is the right, I shift it to the right. Yeah. So you guys could see this is 61.8% exactly, right? The golden ratio. So still no change, using 26,570 for any potential pullback to maintain that bullish biasness above 27,570 for the Hong Kong 33, represent the Hang Seng Index. Resistance level in first step to watch out for will be the 27,500. A breakout above it will potentially seek out the next intermediate resistance from an intraday perspective will be at 27,710, 27,730, which is a Fibo extension cluster level as well. Only a bearish breakdown below 26,570 will negate the bullish biasness to see a much more extension of that minor corrective decline sequence to play out further towards the downside, exposing the next near-term support level, which is the gap up support here at 26,280, also confluence with the rising 20-day moving average. So that's for the Hong Kong 33. Next up will be the Japan 225. So the Japan 225 previously we have a bullish bias over here. So price action indeed moved up higher from the pivotal support that we highlighted, and so traded above the rising 20-day moving average as well, and now go surpass above the upside trigger level, which is at 45,270. All right, previously that we have. So given that it already surpassed this level, RSI at the overbought level over here, so potentially there could be a minor pullback taking shape. Over here, so a minor pullback will be at 45,270. So it will be a range over here. Okay, 45,270, 45,050. All right, this previous minor swing high area now turns into a pullback support. So given that the key risk event that will take shape on Saturday, and the impact could be felt on Monday Asia session again, so I do not want to tighten my pivotal support level to be so tight at exactly at the 20-day moving average, which is 44,840. So I put it the same at 44,560. So 44,560 will still be my pivotal support level. Maintain that bullish bias after the pullback has ended. Next resistance level to watch will be the current all-time high area at 45,960. Above it exposes the next intermediate resistance level, which is a Fibo extension cluster level at 44,430 slash 46,430, pardon me, 46,580 as it moves up towards the upper limit of this medium-term ascending channel that is still in place since 1st of August 2025. Only a bearish breakdown below 45,560 will invalidate the bullish biasness to seek a deeper corrective, to seek out a deeper minor corrective pullback scenario, exposing the next support level at 44,050 next, potentially followed by 43,435. If 44,050 cannot hold, 43,435 will be confluencing with this rising 50-day moving average as well. So that's for the Japan 225 representing the Nikkei 225. Up next will be the Germany 30. So still recall that Germany 30, we do highlight that we have flipped to a bullish biasness because given the fact that the medium-term low has already been formed, and indeed the low has been formed, given that price action yesterday shoot up within our expectation and shoot up very fast all the way breaking above the 50-day moving average, and so coming to our resistance level has already been met at the 24,575 slash 24,655 level, and right now it's fast approach, which is also the current all-time high area here at 24,655. So given now it's really hit this current all-time high area with a rather extreme overbought RSI reading yesterday, all right, over here at 86 level, potentially there could be a chance of a minor pullback taking shape given this extreme overbought level. So minor pullback support level to watch out for today. Give me a minute. Oops, sorry. Where is the, yeah, this is the horizontal ray. Okay, this former minor swing high here of 22nd of August and 25th of August, broken out, now turns into a pullback support, also very close to that minor dip that was formed Thursday at the 10 p.m. Singapore time. This minor dip before it rallied further throughout the US session. So this is the first minor support level to watch. If this minor support level breaks 24,387, potentially the minor pullback may shape a further pushback over here. So this further pushback, if we do the Fibo retracement from the start of Monday all the way up to yesterday, that constitute around the 50% Fibo retracement level as well. And also this bunch of former key congestion area where the bulls got rejected now turns into a significant short-term pullback support area psychologically. So two levels to watch, 23,390. If this level can't survive and break down, the next support level will be at 24,155, 24,090. So that will be my short-term pivotal support. If it comes down to very close to this level, this will be an area to maintain that bullish biasness again, given that we are now potentially see a medium-term low on the Germany 30 as it's broke out above the 50 and the 20-day moving average, and the way it break out, the price action is very fast and furious. So that means i.e. maintain that bullish biasness in any form of any pullback that may take shape, with the adjusted upward pivotal support zone will be at 24,155 slash 24,090. Next resistance level to watch will be at 24,780 after 24,655 has been surpassed to the upside. So 24,780 will be the next resistance level to watch, which is the 2.618 Fibo extension level. Above 24,780 will be the 2.618 Fibo extension level taken from the low of 25th of September at 25,025. That's 2.618. Only a bearish breakdown below 24,155 slash 090 will invalidate the bullish biasness of the Germany 30, as we will see potentially another round of choppy corrective decline sequence unfolding again back towards the bottom part of the range. So in first step, watching out for the next support level to come in at 23,900, followed by 23,760, which is correspond to the rising 20-day moving average. All right, so that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to bounce higher over here. So since it hasn't surpassed the current all-time high, which is at 46,750, 46,870. I do not want to tighten my pivotal support to be so tight at 46,230. All right. So if today later it can surpass above 46,870, then I will tighten my pivotal support up to 46,230, where price action managed to find a bounce at the start of this week for today. All right, so with that, still maintaining that short-term pivotal support at 46,040, which correspond to the rising 20-day moving average, still maintain that bullish biasness. Next resistance level to watch out for will be at 47,160, which is a 1.236 Fibo extension taken from the low of 2nd of September over here. All right, so only a bearish breakdown below 46,040 will invalidate today's bullish biasness to see a deeper corrective pullback sequence unfolding again, revisiting the next near-term support zone at 45,780/45,690, which is the minor swing low area of 16th of September and 17th of September, and also the key pullback support level of the former minor bullish ascending range resistance that has been taken out previously on the 12th of September. So that's for the US Wall Street 30, representing the Dow Jones Industrial Average. Next up will be the S&P 500. So S&P 500 rarely, as expected, hit our resistance level, 6,730, 6,745 over here. Given the fact that it hasn't surpassed above this resistance level yet, I do not want to tighten my pivotal support level to be so tight. For yesterday's Monday minus swing high and Wednesday minus swing high now turns into a pullback support at 6,690. So I will use a slightly adjusted upward pivotal support for today at 6,650. So if we manage to clear above 6,745, then I will tighten my pivotal support towards 6,690. All right, so for now, using 6,650, maintain that bullish bias on the S&P 500 in any potential minor pullback. Next resistance level to watch will be 6,800, followed by 6,850 Fibo extension level, and also towards the upper limit of the medium-term ascending channel that is still in play from the low of 23rd of May 2025 low. Only a bearish breakdown below 6,650 will negate today's bullish biasness to see a deeper slide to retest the 20-day moving average at 6,615 next. All right, so that's for the S&P 500. Lastly will be the Nasdaq 100. So Nasdaq 100 already hit our resistance level, 24,890/24,930, and now fast approaching 25,090. So very clearly, it really cleared up this resistance level. So with that, I could tighten my pivotal resistance level higher towards 24,710, 24,620, which is the minor swing high area of yesterday and Monday, not the pullback support, and as well as the lower limit of this ongoing minor ascending channel that is still in place since 2nd of September. Next resistance level to watch will be at 25,090, followed by 25,360, which is also close to the upper limit of 25,370, not 360, yeah. 25,090, followed by 25,370. That will be my next two intermediate resistance level to watch for the Nasdaq 100 as we maintain our bullish biasness with an upward adjusted short-term pivotal support at 24,710/24,620 as we move up towards the upper limit of this minor ascending channel. Only a bearish breakdown below 24,620 will negate today's bullish biasness to see a deeper corrective pullback slide, exposing the next near-term support level at 24,380, which is the minor swing low of last Friday, 26th of September, and also confluence with the rising 20-day moving average. All right, so very quickly now, let's move on to the commodities asset classes, starting with the Gold XAU/USD. So Gold XAU/USD, yesterday we have a tightened pivotal support level, 3,828, which I mentioned yesterday. So price action indeed hit the resistance, can't break out at 3,892, 3,907 before pulling back, but pullback managed to stall at the 3,828. So this will be still my short-term pivotal support level to watch, 3,828. So as long as 3,828 hold, still maintain that bullish biasness for Gold XAU/USD to revisit 3,892, 3,907. A breakout above 3,892/907 over here will kickstart another round of fresh minor bullish impulsive upward sequence, exposing the next intermediate resistance level at 3,938, 3,942, which is a FIBO extension cluster level. Only a bearish breakdown below 3,828 will invalidate today's bullish biasness to kickstart a minor corrective decline sequence, a much more deeper one, to expose the next near-term support level at 3,785, followed by 3,753. Failure to hold at 3,753 will see this mean reversion decline sliding down lower to expose 3,720, which is a critical short-term support level because it confluences with the rising 20-day moving average, right? So that's for gold XAU/USD. Lastly will be the West Texas oil. So the West Texas oil, as we know, that is fast approaching this key medium-term support level at 6,060.55. RSI remains rather bearish, and in fact, the daily RSI has really started to shape a pre-bearish breakdown signal by breaking below this parallel ascending trend line, also in parallel with the graphical raw price action trend line that's still holding. So we know that RSI is always a momentum indicator. So anything that's momentum indicator has a potential leading effect over here because it's measuring kind of a rate of a change. So given that the RSI has already staged a bearish breakdown, indicating a high chance that the 60.55 will break down as well over here. So given the daily elements are bearish, so on the hourly time frame, we will use any potential bounce over here to fit this bounce to maintain that bearish stance on the West Texas oil. So first bounce to look out, first resistance to look out for in this bounce, given the fact that the hourly RSI has started to exit from the oversold level, will be at 61.85. Maximum will be the rejection area over here on yesterday at 62.60. All right, so 62.60 will be my Titan short-term pivotal resistance for today. Okay. In fact, it's a zone. Let's put it a zone given because it's very close to the 20-day moving average as well. Over here. All right. So this will be a zone. Okay, 62.60/63.30. Okay, so this is a zone because it's so very close to the 20-day moving average. So 62.60/63.30, maximum area for the bounce to take shape. So we'll still maintain that bearish biasness for the West Texas oil. Breakdown below the 60.55, 60.10 level, potentially expose the next near-term support level at 58.70, followed by 58 figure level, which is this minor swing low area of 8th of May, and also a bunch of FIBO extension cluster level on the downside as well, taken from the high of 26th of September. Only a break up above, a bullish break up above 63.30 will invalidate the bearish biasness on the West Texas oil to see a further squeeze up to revisit the 50-day moving average again at 64.90/64.55/64.90. All right, so 64.55/90. Okay, let me put it in better writing. 64.55/90. Okay, so that will be the next resistance level to watch if the short-term pivotal resistance is taken up on the upside at 63.30, which is confluence with the downward sloping 50-day moving average. So that's for West Texas oil, and also sum up all the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today's key data, the non-farm payroll data will be likely not to be released, like I shared earlier at the start of today's daily dose session. So the key US data to take note of for today. Before that, there's one event to take note of that could influence the sterling dollar and the sterling pound. The sterling dollar rate and the sterling crosses will be Bank of England Governor Bentley's public speech at 9:30 p.m. Singapore time. All right, then thereafter come will be the all-important US economic data to take note of, given that today there will be no release. Very unlikely they will release the non-farm payroll data. At 10 p.m. Singapore time will be the ISM services PMI data, which is very important. Why? Because this is a leading survey-based soft data based on survey, and services industry constitute services activities, which constitute 3/4 of US GDP growth, And in the last few months, it has been lackluster, going to inch down towards the 50 level line. So anything that's 50 is still expanding, but below 50 is contraction. But the rate of expansion has greatly reduced. So market participants or consensus is now looking at 51.7. Below 52. So if it came down below than what market is expecting at around 50 level, or was still going to a contraction level, that could increase further Fed rate cuts bets as being priced in by the Fed funds futures traders. And market will be looking at the subcomponent as well. There's no subcomponent called the ISM services employment. So it is a survey based on a set of questions. The ISM will survey a hiring manager in the services industry in the US, whether they are employing workers or not. So this services employment subcomponent has been declining way below 50 at 46.5 in the previous print. So market participants are looking out whether this print will going to deteriorate further on the downside, given the fact that there will be no release of a non-farm payroll data for today. So if it continues to deteriorate further at around 45 to 43 level, okay, let me share the trend. It's pretty bad over here. Okay, it continues to inch downwards since June, right? So it's going to go down below the previous print. That could increase the odds of a deteriorating US labor market. All right, so this is something to look out for at the 10 p.m. mark Singapore time over here. So I don't think the non-farm payroll data will be released over here as well. And also over the weekend, two things to look out for. On Saturday will be the Japanese LDP party election to elect their leader and the new Japanese PM. And on Sunday will be OPEC Plus meeting. So that could potentially influence Monday movement once the Asia session open on West Texas crude oil price, the Japan 225 CFD index, the dollar yen, and the yen crosses. So with that, that's today's daily session. A bit longer. Why? Because of the key data that I'll share with you guys that will take shape on the weekend. Or events that will take shape on the weekend that could impact on the markets on Monday. So with that, this is Kelvin here signing off. I wish you all a great weekend ahead, and we shall speak again on Monday. Thank you.